Hi people, today we're going to be doing adjustments. Basically I'll be giving you a cheat sheet. I swear there's no better way to be saying this, but I'm going to be giving you a cheat sheet with adjusting. And this is literally going through every part of the adjusting journals, the different types, or the big four, the acc- the accrued expense, accrued incomes, incomes received in advance. That when you have a transaction like that, which is normal, I'm not saying if there's no catch, I'm just saying if you have a transaction like that, how do you deal with it? So basically I'm just giving you the journals. What do you debit, what do you credit, and you jot it down. This is the one way I ensure that I maximize my marks, because understanding these principles and knowing them off by heart, and then when you get there you apply it to the question. So what changes is the amount, but the journaling doesn't change unless if the transaction is telling you something different. That's when you know that, okay, I must be a reversal. But you'll know that the two accounts that are affected will be rent income, for instance, and accrued income or income received in advance. And if they recorded it incorrectly, you know that you have to switch them. So basically I just want you to know what is affected with adjusting. Yeah, so we have adjustments summary. Right. So firstly, I'd like us to start with accrued income. Okay, these are incomes that has been earned by the business but not yet paid. Ne? So these are incomes that have been earned by the business but not yet paid. Okay. So let me show you how, if you're in an exam and you're not understanding how to get to what accrued means, you start here. You start with income received in advance. In advance. And you ask yourself, what is income received in advance? Okay, it means I was giving selling off a part of property, or I was giving off a service and they paid me in advance, right? Meaning that this one, they haven't paid you yet, right? Them not paying you yet, it means that the accrued expense means that you haven't paid yet. Then prepaid expense means you paid for the next financial year. So you can figure it out from starting from income received in advance. Income received in advance, they paid me for the next financial year. Accrued income, they haven't paid me, right? They haven't paid me. Then accrued expense, I haven't paid them. And then prepaid expense, I pay them for the next financial year. The accrued here is giving off the accrued expense one. So if they tell you that it's a normal um it's a normal transaction, and they're like rent income was accrued, you know that you debit your accrued income, right? And you credit your rent income. Okay, how do I know that I debit my accrued income? It's because accrued income is a what? Is an asset, right? Accrued income is an asset, and income received in advance is a liability. Accrued income, for the account to increase, it has to be debited. And incomes like rent income or whatever that is going to be against your contra account for accrued income will basically be an income. Incomes increase on the credit side. Sorry. How do I know this? I know this by this dead click. Those that have I've been assisting know that I'm big on this. just your token to success in J. So you debit all expenses, assets, and drawings. You credit all liabilities, incomes, and capital. Debit expenses, assets, drawings, credit liabilities, incomes, and capital. I hope that makes your life more easier. And next time when you ask yourself, where does it increase? You go back to this. So I know all the time that incomes increase on the credit side because of my beautiful debt click. So then your statement will obviously be, this will be statement of financial position. This doesn't look important, but it is. It gives you like 1.5 marks. So just write it down, and then this will be statement of profit and loss, right? So let's move on to income received in advance. I feel like I wrote it really down, and yeah. Okay, I did say that it's a liability, meaning that if they say they paid rent income for the next financial year, you know that obviously liabilities increase on the credit side, meaning instantly you'll have credit income received in advance, and you'll debit your rent income. This rent income is obviously statement of profit and loss, and this will be financial position because it's a liability, right? So now let's move on to our accrued expense. And prepaid expense, right? So let me switch off the slide because I feel like it's making the, yeah, I think that's better. So now we have prepaid expense. So we're dealing with these two now. So your accrued expense are the expenses that have occurred but the business hasn't paid them, right? So these accrued expenses, right, will be contra accounts, will be rent expense or a water and electricity. Those are the usually like normal normal transactions that they give you, but it is a liability, so you know that you're gonna credit it obviously because liabilities increase on the credit side. Statement of financial position, and then you will debit whatever account. Let's just say it's water and electricity in order for it not to be the same with this one. So water and electricity, right? And then prepaid expense, oh, this would be statement of profit and loss. Prepaid expense will obviously be what you paid for the next financial year, right? So it will be an asset because anytime you can call them and be like, dude, I want my money, I'm changing the company that I'm working with, I don't want to work with your company anymore. So it's an asset. So you're going to debit prepaid expense, um and then you're gonna credit your water and electricity. So it's not necessarily always water and electricity or rent income, it's your expenses or your incomes that are in relation to the transaction. I'm just writing this in order for you to remember, okay, what, where am I debiting this big for? Accrued. Something looks wrong here. There's an ITY. Water and electricity, statement of profit and loss, and this will be statement of financial position. Yeah. So basically this is the basic of it. And how do you narrate your your journals? You're going to say recognize accrued income for the year. Recognize income received for the year. I'm saying when it's straightforward, not when it's a reversal. Then if it's a reversal, you're going to say derecognition of accrued income, derecognition of income received in advance, and so forth. So all the time, you know that when you are putting it into your books for the first time and they're saying it's not recorded, you are going to say recognizing. And then when they're saying there's an error and it wasn't supposed to be recorded like that, you are derecognizing. You are seeing and you're not seeing at the same time. So I'm going to erase this because I think I'm done with the big four. And then I'm going to move on to the consumables on hand, to the increase in expected credit losses and so forth. Then that will be the end of the video. So I'll do that off camera now and come back in like 2 seconds. All right, let's start with consumables on hand. So consumables are literally the things we use into the business. This is stationery, or sometimes they write it as stationery specifically. Sometimes it's like packing materials, and you know that it's consumables. But if it's written stationery, stand with the um, stationery. What do we call this? Stationery term, yes. So I think I should just explain this using stationery because I noticed a lot in this chapter that they use stationery mostly. Okay, let's use stationery. Stationery. Okay, so usually they give you an amount and they're like on the trial balance or statement of financial position, and they're like stationery on hand, right? They give you stationery on hand, right? So I want you to understand that this is the closing, right? And then there is stationery expense, and this is the one that we use during the year. So this would be in our statement of profit and loss, right? And then obviously there will be like beginning stationery, which is on hand but for the previous year, right? So this will be in your statement of financial position. So if they tell you that we have stationery on hand and we used this specific stationery of the year, what you're gonna do is, because expenses increase on the debit side and asset, because on hand has to be an asset and this is an expense, what you're gonna do is you're gonna debit your stationery expense and statement of profit and loss, and you're gonna credit your stationery on hand. Stationery on hand. So statement of financial position. This is an asset and this is an expense. This is what we used during the year. So I'm not I'm not I'm not saying it's gonna be complex more than this. They just do it like that or they switch it and they are recognizing. But this you'd be saying recognition of stationery expense. Basically, that's it. You debit the expense and you credit the stationery on hand. Why? Because we used this, and because we used it, it's no longer an asset, it's now a what? An expense. So I hope this one is understood. I try to like um break it down into like different points so you understand, but you know that this is the ending part. So you debit your stationery expense and you credit your stationery on hand, right? That it's that time again. Let me erase and I'll be back. Now we're moving on to inventory deficit and inventory surplus. So this they're going to give you two parts, and they're either gonna say the physical inventory is this, and then maybe you have to no, you have to calculate the physical, and then they say the theoretical is this, or one of the two, right? So if the physical inventory, I'm just gonna write it in short, is greater like this, with theoretical inventory, what was counted by the business or what they assumed they had, meaning that you're going to debit your inventory and you credit your cost of sales. Inventory will obviously be statement of financial position and statement of profit and loss. All right, so in this case, this is obviously a surplus, because we counted, we thought we had this, and now we have something great, meaning we're having a surplus. But if we're having a physical inventory less than theoretical inventory, meaning someone is stealing deficit. So you credit, oh sorry, you debit your what? Your cost of sales, and you credit your inventory. Quite the opposite, right? Yes, it's just basically that. And you just need to put in your financial statements, man. Doesn't even take you 3 seconds. Write them in order to ensure that you get the marks. We just lose marks unexpectedly, and we ask ourselves, why didn't I get 2 because I don't have any wrong answer on my paper. Honey, you didn't put in your statements. So, communication marks, put your statements. Now let's move. We are left with the last one, which is provision for expected credit losses. And yeah, let me read again. All right, so now let's get to the one that is stressing people. So we're going to start with credit losses written off. So credit loss is an expense, so you're gonna debit it, debit credit loss, and you're gonna credit your trade receivables. So this occurs when they are saying Banbani is considered insolvent, and yeah, is considered insolvent. Then you have this. Sometimes they say is considered insolvent and has paid maybe 20% of the debt. You're also going to credit your bank. So you're gonna put 80% here and 20% under the bank under credits, because oh no, I'm making a mistake. You're going to They're going to say to you, for instance, you are having 80% still owed, right? And then 20% was paid. Sorry about that. So now your trade receivable takes the 100%, and then your bank takes the 20%, and then your credit loss takes 80%. I made a mistake by saying you credit bank. No, you actually debit it, because money is coming in. You see, when you're saying things and now you're saying you debit, you credit bank, and you're like, is money going out? No, it's not. These are the questions you should be asking yourself in the test. Is the money going out? No, it's coming in. So we're debiting it. So yeah, I think that's all for this. So you know that you're going to debit your bank as well. So now let's move on to credit loss recovered. Credit loss recovered, you are going to obviously debit bank because money is coming into your business. Please don't forget your statements, profit or loss. The mark is finishing. Hey, financial position, statement of financial position, and you're going to credit your credit losses. We're reversing this, but with bank, because they are paying. So now let's move on to provision for expected credit losses. Provision for expected credit losses. If there is an increase in this provision of credit loss, increase. You see, I'm saying increase, so there's going to be a decrease. brace yourself. There's going to be a decrease. So if there is an increase, oh, you can't see. If there is an increase, all right, so you debit credit loss and you credit your provision for expected credit loss. Hey, I wrote it in short because wait, the mark. Yeah, you write it in, you write provision for expected credit loss. And then if there is a decrease, you're going to debit provision for expected credit loss and credit loss. I know. We're coming to the end of a generation. Gladly, this is not the last video, so I'm going to buy more. Okay, so we're going to decrease credit loss and we're going to credit loss and debit provision for expected credit losses. This is when there's a decrease and you're going to increase credit loss and credit provision for expected credit losses. So I think that's all. You know that your credit loss is statement of profit and loss, and this one will be statement of financial position because we subtracted from our trade receivables at the end of the year to get our net debtors. We know this by now. So yeah, I hope this video assists everyone and it gives you the cheat sheet. One day I will have the material and the resources to release a book or something where I'll be giving off ways to just remember how to journalize, and all first year students will be like, wow, she offered a cheat sheet. But yeah, until then, please continue watching my videos and hoping to see you in the next video. For now, from me to you, it's bye and see you later. Ciao.